But what do you make of the market action so far? I mean, where's your head?
So my head is the market is still thrashing around with, oh my God, look at the inflation numbers, versus some underlying changes going on. So there's rotations going on, which makes everything feel super choppy. Every bear is shouting, oh my God, the Fed are going to raise rates, everything's going to crash. There's the deflationists, who I would count myself into that camp, saying the world won't take higher rates. And if you raise the rate of inflation higher, faster than the wages, you're going to see consumption fall. So there's this battle going on in the markets right now and in narratives. And obviously the inflation narrative has taken hold, but I'm starting to see forward-looking indicators suggesting that it's not going to stick. And that's contentious in itself. So everyone wants to throw poo at each other over Twitter, even suggesting that's happening. But that's the world we live in.
It's so true. This is a time when there's very little consensus. It's confusing for people.
Yes, it is. And that's usually what happens when you're at the end of a particular market regime. So, you're starting to see the two different narratives fighting for control. And it feels like that's the situation we're in. Doesn't mean it happens overnight. I think market volatility is the outcome for a while longer until people get comfortable with, okay, what is happening? Now, it's pretty straightforward to me, is if the bond market, if we look at the yield curve, it's flattening. If that breaks those recent lows, it's telling us the Fed cannot raise significantly more, or even the 4 times that they're talking about. So then we will start to see the 10-year bond yields peaking out. That would be at the top of that long-term trend, the chart of truth, as I call it, which is the 30-year channel of bond yields. About 2% is the top of that channel. Sometimes at the peak of the cycle, it goes to a little bit through, 25 basis points through. So somewhere around then, you'd start to see the reversion. We're starting to see the ISM new orders, the ECRI. We're starting to see retail sales today. All sorts of indicators saying the Atlanta Fed came and revised down growth this morning in their Fed Now model. So I think that's the macro shift that's underway. And we've seen it as commodities stopped going up, really. Some commodities have rebounded, but it's been less clear. The inflation trade is less clear in the markets any longer. And we've got this value growth rotation. The kind of core kind of tech, super long names are still getting smashed. But as soon as the bond market turns around, they'll turn around too. So if you're a bond trader, your entire job is to analyze inflation and GDP growth. That's it. If you're an equity trader, you're trading sentiment, you're trading earnings, you're trading buybacks, you're trading all sorts of things. Bond traders do 2 things: inflation, GDP growth, which is why they tend to be right, because that's what they get paid to do, is look at 2 things only. So over time, very rare the bond market's wrong. 1994 was the only time in my entire career the bond market's been really wrong about things. So I always pay attention to the bond market, because I call it, the bond market is the truth. Look at wage inflation and think, is net incremental demand in the economy going up? Well, wage inflation is less than inflation, so we've got negative real wages. Secondly, there are more people leaving the labor force than ever before. The labor force participation rate is super low. Many of those are baby boomers who have high incomes and high earning power. So you're offsetting millennials, giving them an increase. They earn a lot less than they are leaving. So net, you've probably got a fall in total demand. And you're seeing it in the numbers already, I believe, which was the retail sales numbers that came. Partly it's Omicron, it's not clear yet. But my view is that we're actually lowering the trend rate of growth, but people can't see it because we're still dealing with the machinations after the pandemic.
Yeah. What do you think this means for the Fed then?
So my view, and it has been all year, and I've been looking at this whole junction all year because I think it's the bigger trade, is I think the Fed are not going to deliver what they say. I looked at every recession going back to 1963, and almost every single time there is a growth scare early on because the economy's not fully stabilized yet. So what happens is stimulus comes out of the economy, fiscal stimulus. The Fed start talking about tightening because inflation's risen, because the year-on-year rate of change and stuff like that. This time we've got supply issues. And then what happens is the Fed think about raising, and before you know it, growth evaporates again. And then the Fed actually end up cutting. So I think we will get a couple of rate rises in, potentially, maybe only one. That's my view.
Why?
Well, because I think by June, I think inflation's back down to 3%, and the ISM is probably closer to 52 than it is to 60. So you don't want to tighten into a falling economy going into an election. I know the narrative now is, well, they need to tighten to look like they're fighting inflation. Best thing to do is talk tough, get a rate hike in, maybe two 25 basis points in, then let the natural kind of ebbing and flowing of the economy work in your favor. You can say, we've beaten inflation, and then you can get a stimulus package through.